Hey guys, it's Doc's Market Minute for Wednesday, July 29th. I'm looking at a chart of Gilead, or GILD. And so you can not only see the daily price action, but also in the lower chart here, the lower study, you can also see the implied and realized volatility. So the blue line is the implied volatility, and what we had seen recently, because this was leading up to earnings, is that Gilead was spiking in implied volatility. Doesn't seem like much, but it was actually a relatively high value as measured over the last year. Now we looked at Gilead and we said, okay, when it does have earnings, how much does it really move? And most of the movements were well within 10 points or so, usually about 6 or 7 points, and some cases very little at all. So each one of these is an earnings report in here, and we can kind of get the history about how Gilead responds after earnings. Obviously we can't predict the future by looking at the past, but we can get a pretty good idea of how it tends to respond. So what we can do in a case like this is we can set up a trade where it likes the collapse in implied volatility after the earnings release. And actually an iron condor works pretty well for something like that. So we set up this iron condor with options that expire this Friday, right? So very, very little time left. And we were actually able to get these legs of the iron condor out about 1 standard deviation. So about plus or minus 7 points from the starting point here. So we've gapped a little higher and it's faded back in, and it looks like we may be able to just leave this thing alone to expire later on this week, or we can just grab our profits right now for a little bit of a cost to shut them down. Now, there are going to be times with this trade where the price just explodes and does like a Google or like an Amazon or like one of those stocks and just goes well beyond a 1 standard deviation. So it forms one of those, extended tail type reactions. And this is why it's important to be able to set up a risk reward line here. Ideally, it would be 1-to-1, but we're not going to be able to get that and get any kind of width for this trade. So this is a compromise, just like everything else in trading, is that we're balancing out our probability versus the risk reward on these. And typically, if we can get an iron condor with a 1 standard deviation width to them, plus minus on here, then we're going to win a majority of these trades. And the key obviously is that if we can increase our odds from that 68% that we start with by looking at the edge of the trade and making sure that we're picking the ones that have exceedingly high implied volatility, first of all, and secondarily is that its past history doesn't show typically that big a reaction to this, then we can put the odds in our favor on trades like this and win more than our fair share. That's today's Market Minute. Thanks for listening, folks. We'll see you tomorrow.